Good afternoon. It's Jeff Christian. It's Monday, November 1st, and we're recording this because Tuesday is going to be a bear, so we won't be having time to do video on Tuesday morning the way we normally have been doing. So we're doing this Monday afternoon. I wanted to give you a little update on silver and our price expectations, as well as supply and demand expectations. And then I also wanted to talk a little bit about inflation. These are both topics that we covered in early September in the case of silver, and probably early October in the case of inflation. But I think that they warrant some renew. So if you start by looking at silver from a long-term perspective, here we are, and the price is trading. This is through April, so this is a little bit out of date. The price is basically trading between $22 and $27 an ounce this year. I'll show you a chart of prices this year in a second. So it's relatively high. It's not as high as it was during that big surge from 2010 to 2013, but it's much higher than it's been at any other time before, prior, except that prior to 2020, 2021. We've seen the price spike up. It's out of that range that it was in from 2014 through 2019. And it seems to be building a base. And that's really something that we've been talking about for some time, and it's happening. The strength that we've seen is a direct reflection of investment demand for silver. We saw silver investment demand rise very strongly from, well, really 2005 into 2013. It came off. It was very low for 3 years, 2017, 2018, 2019. We saw a big surge last year, which took the price sharply higher. And then we are actually seeing probably greater demand for physical metal this year than we saw last year. Now, these are our figures, and they factor in very well in that if you use our estimates of supply and demand and investment demand, in calculating and projecting prices, you have a pretty good track record projecting prices. There are two sets of swamps on either side of the road to getting your projections correct. On the one hand, you have promoters and people who want investors to buy silver from the industry, and they use really bad data. It's just bad data. So they have much higher figures for investment demand than ever before. And if you scrutinize the data and you tear it apart and you know what you're looking at, you say, wow, I can see why this engine doesn't run. On the other side of the road is another swamp, which is people who don't have data. They just say, hey, the price of silver is going to rise because the world's going to hell in a handbasket. And, you know, that's communists and socialists and other people who are just going to destroy the world. So you better buy silver because it's going to be $100 or $200 or $5,000 within any moment, you know. And they've been saying that for not this year, not last year, but for 20 years, 40 years, 50 years. As long as I've been around, I've been hearing this kind of stuff. It's not based on science. It's not based on fact. It's not based on reality, and it's not even logical. It's, you know, inconsistent with observed reality. So you've got to sort of walk that narrow path, that narrow straight line in between the swamps, the quicksand that can catch you on either side. Now, looking at silver now, this is the price of silver over the course of this year. And you see, you know, the price was trading $25, $28 in the first 2 months of the year. We had one spike up to a little over $30. That was the let's squeeze silver and drive the banks out of business fiasco. I think that's probably the best term for it. As people and investors started saying, wow, that was stupid, they moved away from it, and we saw the silver price come down. It was also at the same time when we saw other factors, stronger economic activity, the beginning of the positive effects of the vaccinations on a national and global basis. There was more optimism economically. The stock market was doing well, and you saw silver prices come off a little bit. They rose again later in April and May and June, and they got back up to around 28, 28.50. And since that time, they've fallen down. Now, if you look at the price, it sold off sharply at the beginning of August. It kind of recovered, but it couldn't really get over $25 an ounce. It then came off again over the course of September into the early part of October. And it actually tested about 21.50, which was about $1 lower than we thought it would go when we were projecting shorter term prices. Since that time, it's been rising. It's gone back up and it's tested 25 once, but quite frankly, it's really struggling around $24, $24.50. But if you look at it, we've seen since late September higher lows in the silver price. It's sort of trapped in that trading range, and you could say it's $23 to $25 or $22 to $25, depending on how you want to draw that range. But the reality is that you've got these higher lows, and we're testing at $25. It's quite possible that we will break above that $25 at some point, and you could see a run up as high as $28.50, depending on which technical analysis you look at. Any such increase would probably be relatively short-lived, as it was in the March, April, May period, and as it was in the first quarter of this year. Our expectation, as I've said numerous times, is that we're seeing it flat to slightly higher, modestly higher over the course of 2022 because of economic activities and relative strength in the economy and relative strength in the stock market and the bond market. And then the possibility of much higher prices when some of the fiscal and economic problems and political problems become worse, which we think will be after 2022 into 2023, 2025. So that's our price expectation. A couple other charts. Again, I've shown these before, and they're in our precious metals advisory, the monthly report that we do on precious metals. Comex open interest, you can see over the course of the year, it actually got pretty high when the price went up to test $28 in the middle part of the year, and it's come back off. And you can see on the right-hand side chart, open interest, the long and short positions of investors. Short positions relatively flat, a little bit greater than they were beginning of the year, but not as high as they were in the middle. I'm sorry, greater than they were in early 2020, not as great as they were earlier in 2018, or later in 2018, 2019. And then the long position has come off, and the net position, longs less shorts, has also come down really to its lowest level since around 2018, 2019. So you're seeing some investors walk away from silver, not a lot, but some. And these are shorter term investors who don't want to buy silver and take delivery of it. These are people who are trying to play the shorter term price exposure. So they're buying futures and options, looking at short term price moves. And what they're basically saying is, I'm not playing this market on the long side as much as I used to. I have less optimism or expectations. I have fewer expectations of stronger gold, silver prices now than I did in the past. And I'm backing away from that. And I might even be increasing a little bit my proclivity to short silver at times. So I think that's one of the shorter term factors that you have to pay attention to. And we've seen that in the price. The price goes up, you have renewed selling. The price goes down, you have renewed buying. There's a sort of a stalemate between longs and shorts in one hand. And the other hand is a lot of the people who are going short were also the people who go long. They trade these ranges. They see the price at $23, they buy. They see the price at $24.50, they sell. They see the price back down to $23.50, they buy. It's not that there's necessarily a battle being waged on the futures market between longs and shorts. A lot of the shorting and long buying is actually the same people looking to take advantage of shorter term price moves. On the physical market, Just want to reiterate something that we've said before. This is actually from our August 2021 Precious Metals Advisory. There is ample silver in the ground, which I talked about in our silver video back in early September. And there's also ample silver above ground. The effort to drain the swamp, drain silver out of New York has pretty much failed. You can see it's gone from what, 400 million ounces in registered and eligible stocks in New York to about 350 million ounces. And that is higher than it's been at any time prior to 2017, 2018. You also have record large silver inventories in London and very high inventories in Shanghai in the China market. So you've got plenty of silver around. Now, I mentioned that you saw some dissipation of the shorter term new wave of new silver investors. If you look at the physical market, demand is holding up well. We have very strong coin purchases on the part of investors this year, physical purchases of coins, and those are longer term investors who tend to buy and hold. And you also are up about 81 million ounces in silver ETFs so far. So that's the outlook for silver. I want to talk a little bit about inflation, just going over again grounds that I've gone over before. You've seen this chart. This is CPI, all factors, including oil and energy, which tend to be very volatile. And this is, so it's what they call headline inflation. You can see this big spike up, and it's higher than it was really, well, it got as high as it was at the beginning of the Great Recession, and it's gotten as high as it was a couple times earlier, but it's far from the inflation rates that we saw in the 70s, which was when silver went from $2 to $50. But if you look at it on a month-to-month basis, and I made this point last month, and I want to reiterate it, you look at month-to-month changes, the month-to-month changes have come down. We saw this period, March, April, May, June, of very high increases in price levels from one month to the next. And most of that increase was in used cars and oil-based energy. You also had increases in food prices and in some other factors, but it was mostly energy and used cars that you saw the big drive. Now, we got up to 0.9% 1 month change in June. Since that time, it's come back down and it's running about 0.3, 0.4. That's still relatively high, but let's take a look at that. These are month-to-month changes in the CPI, all items less food and energy. So this is the core inflation, taking out the volatility of food and energy. And you can see that big spike up in the middle part of this year. And you can also see that in the last month or two, it's come back down to 0.3, 0.4. And if you look at 0.3, 0.4 and you say, well, gee, when's the last time we saw inflation that high? Whoa, it goes all the way back into the early 1990s. So when the Fed and mainstream economists start talking about the transitory nature of inflation, this is what they're talking about. It's something to pay attention to. That's all I have for this day. Like I said, we're kind of booked up here Monday, Tuesday. I'll be back with you on Friday. In the meantime, enjoy the beginning of November.